How do you generate great returns while minimizing risks? Any guesses? Well, according to Howard Marks' experience, the safest and easiest way for investors to make money is to do things others are hesitant to undertake. So, what has been the most prominent feature of the financial climate in the recent decade? Low interest rates are the answer.
What has been the dominant characteristic of the financial environment over the last 10 years? And the answer is low interest rates.
Interest rates were often at all-time lows at the time, and while they have been increased in recent years, they are still deficient. It has the effect of increasing the discounted cash flow of most firms, increasing their value, and boosting many enterprises' economic outcomes. That's why, more than 1 decade ago, the world's central banks slashed interest rates to combat the global financial crisis, and it worked. However, this has resulted in an investing climate marked by low interest rates, which is why we're discussing them today in our video. So Mark still thinks today's uncertainties are unique in terms of scope and insolubility, and that anticipated returns in many asset classes are historically low. Because of the low interest rate environment, asset prices range from complete to high, and pro-risk behavior is expected depending on the asset category. In Chicago, 50 years ago, they taught him the importance of risk aversion in producing the positive connection between risk and return. When individuals are risk-averse, they will conduct comprehensive due diligence. As a result, the market will be a safe place, but unfortunately, they occasionally neglect to do so, resulting in pro-risk behavior and a hazardous atmosphere. The bottom line, Mark believes, has been and continues to be that we live in a high-risk, low-return environment.
The bottom line, I think, has been and is that we're living in a low-return, high-risk world.
Investors expected huge overall returns 20 years ago than they do today while taking incremental risks. They needed at least a 4% yield on T-bills with no risk and a 20% return on private or public equity investments, he said in a lecture that is now available on YouTube. Central banks have lowered the risk-free rate from around 4 in 1999 to around 0 since the global economic crisis. In certain countries, short-term rates have gone negative to encourage economies. Low returns ensued when the threat rate was lowered to 0. If the yield on cash is nil, I'm not going to put my money in a savings account for 5 years until I can receive 1%. I need 1.5% for 10 years, and so on. I wouldn't purchase high-grade bonds until they paid 3%, and I'd never buy high-yield bonds unless they paid 6%, and so on, the seasoned investor explained. Marks believes that investors have forgotten the value of moral hazard in the current low, high-risk environment and engage in pro-risk behavior. Marketplaces have been formed by optimism along with a low rate of skepticism in the latest days. A high level of risk tolerance aided asset price rise, he remarked.
And investors, a low level of skepticism and risk tolerance, not risk aversion.
According to Marks, there is a widespread belief that riskier investments provide better returns and that if an owner wants to earn extra profit, they must take more risks. On the other hand, he does not share this viewpoint. By theory, riskier assets would not be riskier if they could be depended on for higher returns. This link, in my opinion, indicates that riskier investments must appear to promise larger returns, but they do not have to deliver, Marks explained. Traders seem to be pressing out of the capital market in quest of bearable yields in the low-return environment. It is earning money to pursue limited chances in the risk markets, which is earning money to chase limited possibilities in the risk markets, says one analyst. So a lot of money has been flowing from certain asset classes to risk asset classes, Mark explained. According to Marks, to earn high returns while minimizing risk, an investor must make money securely and quickly by doing activities that other investors are afraid to do. Market excesses should be avoided. Marks thinks that market excesses should be avoided. To do so, an individual shall have a basic understanding of history, believe in phases rather than being fixated on unidirectional patterns, and be skeptical of free lunches. According to him, paying attention to these details might help investors become long-term market survivors. He stated that there are times when traders should be competitive in the marketplace and times when they should be cautious. He added that investors should be active in the market at times and cautious at other times. The moment to be bold is when negativity is pervasive, prices are low, and investors are fleeing danger. It's time to be cautious when prices are high enthusiasm is strong, and investors are risk-averse. He adds, in a low-return world, Marx proposed 5 investment options. To accept modest returns, invest regularly. Even though it will not match many organizations' business plans, Marx believes that investors should continue to support, as they have in the past, and accept today's poor returns as a reality in today's society. Accept poor returns by reducing risks. According to him, investors should strive to limit risks by anticipating a market decline and accepting even lower returns. Take the money and save it for a better time. Marx recommended risk-averse investors to stick with resistance to cash and accept returns closer to zero while waiting for a better climate to invest their money. However, he described it as a problematic planned sin. You must be not only correct but also quick. Although if it requires you 2 years to be correct, you will have dug a hole. If the market continues to rise over the next 2 years, but you were incorrect to move into cash, you will still have dug a hole so deep that you'll never be able to dig your way out, and you may not even have a shovel because you've already lost your job, he joked. Consider taking sensible risks. Marx recommended that risk-seeking investors take those risks in the low-return universe to get significant returns with safety, while warning people and investors about the pros and cons. Invest in specialist markets. Marx also advised investors to put more money into niches and individuals and gamble more on alternatives and experienced managers. Take chances to achieve higher profits. According to Marx, if an investor believes in a potent form of market efficiency, the only way to have higher returns is to take on more significant risks or hope for luck. There is no other way to generate better returns in market efficiency since there are no mispricings or the talent to detect them. You can't outperform the market, have alpha, or contribute through active management. That implies an investor's return will be solely determined by market performance and the stock's level of sensitivity to that achievement, which is known as systematic risk or beta. Find inefficient marketplaces. Marx believes that not all markets are relatively efficient and that shareholders should seek out markets with inefficiencies. In these markets, price increases diverge from fair value. As a result, there may be a potential for an outstanding manager to deliver above-average rates of return through the use of alpha, or for a poor manager to conduct below average given the presence of negative alpha. However, Marx noted that an inefficient market does not imply that it distributes money or that everyone who invests in it earns a higher than average return or a higher than average risk-adjusted return. As a result, there will always be a danger. There is no surefire strategy to get huge returns. Markets must be inefficient for investors to stay active, as active investing is founded on the assumption that markets may provide higher risk-adjusted returns and that there are people with the ability to spot bargains and add value by properly managing assets. He claims that there is no surefire method to get high returns in a low-return world since active investors rely on investment managers to know when a company is cheap and costly. These managers might make mistakes, putting your portfolio in danger. All we can expect is that these asset managers do not throw money away for free, he says. Did you find this video helpful and informative? Let us know in the comment section below. And don't forget to subscribe to make sure that you don't miss out on any of my future videos. Remember to like and share the video with your friends, and I'll see you next time with more.